Hello and welcome to this Tolley Seminars online lecture where I'm going to be taking a look at the income tax and national insurance changes announced in the Chancellor's recent autumn statement. My name is Chris Jones. Firstly, I'd like to take a look at rates and allowances for income tax and NIC. The Chancellor has at last confirmed that the annual personal allowance from 2014-15 will rise to the full £10,000, as has been the plan of the Liberal Democrat Party since they came to power. And he's further announced that this personal allowance level will increase in line with consumer price index increases going forward. So therefore there will be a 10,000 annual equivalent of the personal allowance from now onwards. However, it is not such good news with regard to the level at which the higher rate of tax cuts in. From 2014-15, the higher rate threshold will cut in at a level of income of £41,865, which is an increase on the current year. However, the bad news is with regard to how much that will increase going forward. Those increases will not be at the level of the CPI, but will instead be at a level of 1% per annum, so therefore continuing the current theme of a real term cut in the higher rate threshold for higher earners. The Chancellor has also confirmed that the Class 4 National Insurance Contribution profit limit will remain aligned to the higher rate threshold, so therefore the 1% increase of that limit will not only affect income tax but will continue to affect national insurance contributions as well, and that will apply to both Class 4 and Class 1 employee contributions. Also, the Chancellor has announced that the Classes 2 and 3 weekly rates will be increased. Those increases are yet to be announced at the time of recording. Let us turn now to an interesting development which had some attention in the national press in the run-up to the autumn statement, and that is the transferability of the personal allowance, which will apply for tax year 2015-16 onwards. Now, the rule will basically allow an individual to transfer up to £1,000 of his personal allowance to his spouse or civil partner. It does not extend to individuals who are living together as though they are spouse or civil partner. They are literally here, we are looking at husband and wives and civil partners only. In order to make this transfer, it is a requirement that both parties must not be higher rate taxpayers or indeed additional rate taxpayers. In other words, their income must be below 41,865 at current levels in order for this transfer to go ahead, and we are assuming here that we are looking at the level of their income before any transfer of the personal allowance is allowed. Therefore, this new rule will only likely to be of benefit where one of the couple is not able to utilise the full level of their personal allowance. We are also told that the Chancellor will increase the amount that can be transferred in line with the increase in the personal allowance each year, so in line with the CPI. So for example, it will start at £1,000 and maybe a year later it might move to £1,050, for example. Let us turn now to some national insurance changes and the abolition, or certainly reduction, in the amount of national insurance contributions paid by employers of individuals who are under the age of 21. Now, these rules do not cut in immediately, they cut in with effect from the 6th of April 2015. And basically it applies to employer secondary Class 1 contributions where those contributions are between £148 per week and the upper earnings limit of £797. What this essentially means is that where an employer is employing somebody under the age of 21, they will not need to start paying any national insurance contributions in respect of those salaries until those earnings reach £797 per week. However, it does seem to appear that Class 1A contributions on non-cash benefits paid to under 21s will continue to apply as normal. Let us turn now to a change to voluntary NIC contributions, a new rule to come in for pensioners with effect from October of 2015, where a new class of contribution known as Class 3A will allow individuals who will reach the state pension age before the 6th of April 2016 the opportunity to continue to build their entitlement to the state pension. And they will pay a fixed weekly rate of 3A contribution from October 2015 if they choose to do so, and that level of contribution is yet to be announced. Let us look now at investments and pensions. The stocks and shares ISA limit in 2014-15 will be increased to £11,880, and the junior ISA limit, or the cash ISA limit, and the child trust fund limit will be £3,840. The Chancellor has also announced good news for pensioners in that the state pension will increase by 2.7% from 6th of April 2014, and that will move the amount of entitlement from £110.15 to £113.10. Not quite in line with the rate of increase in household living cost, but a welcome amount, I'm sure, for those claiming the state pension. The Chancellor has also announced a review of the future state pension entitlement age, and that is going to be an ongoing review with the aim of bringing forward the time at which the state pension age will increase to the age of 68, and they're looking at 69 or 70 going forward. That is going to be subject to some further review in the future. The previously announced pension investments limits will be confirmed based on Chancellor's previous announcements for 2014-15, in that the lifetime allowance will reduce from 1.5 million to 1.25 million, and the annual contribution allowance will reduce from the current £50,000 to £40,000. At the same time, the Chancellor has confirmed that Finance Bill 2014 will include provisions to allow individuals to protect their pension pot where it is currently in excess of 1.25 million, in that an election will be able to be made that you freeze the level of the pension fund equal to the fund as it stands now, frozen to a level of no higher than 1.5 million. But what that does mean at the same time is that the individual will be unable to make future contributions into that pension fund except to make good an actuarial deficit. So that needs to be borne in mind when making that election. Let's turn now to some new provisions applying some tax reliefs for indirect employee ownership structures. 3 new exemptions have been announced in the autumn statement. Firstly, an income tax relief on bonus payments of up to £3,000 per annum being able to be made to employees of indirect employee-owned companies that are controlled by an employee ownership trust. And these will apply with effect from October of 2014. So the individual will receive a bonus of up to £3,600 without paying any tax on that amount. Secondly, the Chancellor has introduced a CGT exemption on disposals of shares that result in a controlling interest in a company being held by an employee ownership trust. And this will apply to disposals from April 2014. So this could be of particular benefit for an individual, say for example, who owns a controlling interest in a company that he's built up from scratch and has owned for many years. His succession plan is to hand that company into the hands of an employee-controlled vehicle. That individual, making that disposal of that controlling shareholding, will not pay CGT on the disposal. However, there will be a number of rules here, but the main rule to bear in mind here is, of course, this needs to be a disposal of a controlling interest, and that is where there is a particular restriction over that exemption. And finally, the third relief is going to be the ability to make inheritance tax-free transfers of shares and other assets to employee ownership trusts. So therefore, when looking at pets becoming chargeable, they will not be taken into account where the transfer was made to an employee ownership trust. Let's turn our attention now to changes made to SIPS and SAYE schemes effective from the 6th of April 2014. Firstly, for the first time since the introduction of SIPS, the limits will be increased from the next tax year. The amount of free shares that the employer can award to employees will increase from £3,000 in a year to £3,600, and the number of partnership shares that the employer can match with employee contributions will increase from £1,500 in a year to £1,800. At the same time, with effect from next April, the Chancellor is doubling the amount of the SAYE maximum monthly contribution from the current £250 a month to a full £500 per month. So good news there for employees who potentially could save through the SAYE system, particularly employees of larger public limited companies. Turning now to benefits in kind and apprenticeships. A number of interesting changes have been made to the car benefit rules, which are going to be coming in from April 2014. Firstly, a restriction of relief for employee contributions to only allow such relief from the car benefit charge, i.e. deduction from the car benefit charge, where the payment is made in respect of private use of the vehicle. And therefore the wording of the company car scheme needs to be looked at very, very closely here, in that a number of employers do offer employees the ability to contribute towards the car, to have a better car, for example, to have a more luxurious vehicle, to have leather seats, or to have a bigger engine, or an estate car, or basically just have a nicer car. In those circumstances, because the employee makes a contribution to the car, that is deducted from benefit in kind. But going forward, it can't be that the employee is making contribution to have a nicer car. They must be making a contribution under the terms of the employer scheme to actually use that car for private motoring. And that's a tightening of the car benefit rules. So have a look very closely at the wording of company car schemes of your clients. Secondly, there has been a bit of a loophole that some employers have been able to take advantage of over when they use discounted leasing arrangements for their employees. For example, a large employer is able to negotiate cheap car leases by using their bulk buying power to allow their employees to lease cars at a better rate. In the past, the cars leased to those employees at those reduced rates have been taxed as employment income, but going forward, new legislation is going to ensure that those arrangements will be taxed as a car benefit, because indeed the employer is providing a car, with a deduction, of course, for any contribution towards the private use. So be very careful about those types of arrangements going forward. The Chancellor has also announced a £500 exemption for any payments that an employer makes for the medical treatment of an employee that has been recommended by Occupational Health Services. In the past, such medical treatment was taxable. Now the first £500 will be exempt. And the Chancellor is also going to be putting out to consultation changes he is proposing to the apprenticeship schemes. Firstly, a compulsory contribution by employers to external training costs will be required, and secondly, there could well be a cap on government funding. Further details are in the written notes accompanying this month's release, but it is worth you looking through some of those details if any of your clients are looking at the apprenticeship scheme. And finally in this session, I'd like to look at some changes here with regard to dual contracts and closed company loans. Some changes coming in from April 2014, i.e. from the next tax year, looking at dual contracts. New legislation will override the effect of a dual contract arrangement, which in reality represents a single employment, which will mean that essentially UK tax will apply to all of the employment income under the contract, where a comparable level of tax is not payable overseas on the overseas contract. In other words, if under the dual contract arrangements some of the employment income falls away from tax altogether anywhere in the world, it will be fully taxed in the UK. And secondly, Finance Bill 2014 will extend income tax relief on loans taken out to invest in close or employee-controlled companies registered anywhere in the European Economic Area, whereas previous legislation has only allowed the relief in respect of investment in UK close companies or employee-controlled companies. So that is to bring to bear some of the changes that have been made more recently in respect of the freedom of establishment provisions in the EU directive. Well, many thanks for listening to this lecture on the income tax and NIC changes of the Autumn Statement. My name is Chris Jones, Director of Tax Markets and Learning Solutions at Tolley.